All right. Good morning. Good morning. How are we doing this fine day? This fine Thursday. Hope you guys all had a nice Valentine's Day yesterday and make it back. Take a look at the markets. Markets went a little crazy this morning at 6:30. Oh, man, why did they go crazy at 6:30? Well, because we had some big red news. Retail sales came out at 6:30 this morning. Now that's 6:30 my time, UTC 7. I'm in Utah. So you have to take that into consideration. What time is your time in your time zone? But you can see retail sales came out at 6:30 this morning. The forecast was 0.3. The consensus was negative 0.1. The previous was 0.4, and the actual was negative 0.8. So that's bad. That's bearish. You want that number to be big, not small. And it was a lot smaller than it was forecasted to be. Now, it's not for us to determine whether that's going to make the market go up or down. All we need to know is that that's going to make the market move. Then we come in and look at the market and see and determine whether it's going up or down. But it should make it go down. That's a bearish event. But what's interesting is the minute that it took off, it went way up, and now it's kind of flushed right back down. Come back down to that VWAP as it oftentimes does, right? And we're coming into the opening bell here in, well, right now. There we go. And there's the opening bell, and we're going to expect it to kind of whip around a little bit here as it fills the nighttime orders, and then probably continue to fall. Now we got the Russell. Oh, I got the Russell up here. Oh, this is all the Russell. I don't want to be on all Russell. I want to be on all indexes. Let's go to all indexes. 1 minute. So there's the 1 minute on all the indexes. So there's your Russell down there, kind of whipping all over the place. Here's the S&P 500 up here in the upper left-hand corner, kind of whipping all over the place for the report. Now on the 1 minute chart up here on the Dow, shrink that down. There we go. There's the whip around. Now it's starting to fall as it's flushing out of this opening gate. The NASDAQ is not flushing. It did whip around like the others. I had a great question in the comments section yesterday, and it was, I think it was, come over here to the chat, not that chat. Let's see, comments. There we go. It was Low Down Killer came in and asked a nice question in the comment chat section of the yesterday's video. So if you guys want to see that, he was asking about the opening bell, and he was asking about why it happens at different times and what it is. And so the opening bell is 7:30 for us. That's when the market opens. But what is all this activity back here? And we talked about a couple days ago. We talked about the pump and dump markets. Remember the stock market pump and dumps? And we were talking about that, and we went over and looked at the pump and dump tools that we can use to watch the markets take off and rally, and which ones are shooting through the moon. Look at the Russell taking off. So it's going like crazy out of the gate here. And so he was asking some questions about how they do the pre-market session over in the stock market. So I thought we'd pull up the stock market and I could show you a couple of things. So here's the stock market. And these are the daily charts. And in the stock market version of Track and Trade, and it's the same in many software applications. So depending on what software application you're looking for, you come up here, and in Track and Trade, you go to View, and you drop down here and see how it says pre and post market hours. That turns on the ability to open up and see the pre and post market hours. Oftentimes, stocks, if that's not turned on, you see a gap in the morning. And so you'll say, well, why did it trade in the middle of the night? Why are these gaps every morning from the yesterday's close to today's open? Why does the market gap every day? Well, it doesn't really gap. They're just not showing you the nighttime moves or the pre-market or post-market sessions. All right. So the market trades all night long. I mean, you know that from the futures exchanges. Those indexes trade all night long. So that's why you get a gap in the morning in your stock charts, because you're not seeing that nighttime session. There's also the pre-market session. There's the post-market session. So we have the regular hours, and then they'll open up the market a little bit earlier, an hour or two. Let's go in. I got that set in here too for you, so you can come in and see. This is the 2 minute chart of the indexes. And so you can see where this market in Track and Trade, the clearing firm, brokerage firm that we hook up to, opens this up at 5 a.m. So you can see right here, this was the opening kind of, you could call it the opening bell. It's actually the opening of the pre-market session. So they open it up and let people trade on the pre-market session. But the pre-market session, I know it's weird. Why? Because it's a game of Monopoly and you have to have rules. And that's just the it comes from the olden days when there was not electronic trading and they would let the institutions come in early and trade. And that's where they would do their filling all their nighttime orders and all that kind of stuff. But that's kind of pushed out now, and they kind of do that on the opening bell. But the markets can come in, and people can come in and trade in the pre-market session. So at 5 o'clock, you have this opening up. Some of them don't open it up. Some brokerage firms don't let you open and start trading until 6 o'clock. So you have to. It depends on your broker. The one we're with, brokerage firm that we clear through with Track and Trade, opens it up at 5 o'clock. So you can start trading at 5 o'clock. And the rules, the Monopoly game, are that you can only use limit orders. Okay. So the real market opens up at 7:30 our time, right? 7:30. Now you can use market orders, limit orders, and stop orders. So you can use those three order types at the 7:30. And that's the difference between the opening bell, which is actually starts at 5 a.m., and the 7:30 bell. And again, this is Eastern, this is Mountain Time. So make the adjustments for your time zone. But 7:30, that's when they start letting you use market orders and stop orders. So you have that opening bell. So that's the regular bell. If you come in here and turn that off, if you say, okay, I don't want to see pre-market or post-market hours, well, then you won't see any of this down here, this pre-market move, and you'll just see a gap in the market instead. All right. So there you go. That's how they do it. And they do the same thing at the close of the bell. We close our market at 2 o'clock, which is 4 o'clock Eastern, right? 2 o'clock Mountain. And then there's another hour or two, depending on your brokerage firm, where they let you trade in the aftermarket session. And then you can, again, only use limit orders. All right. So that's the way the game works. And so these guys come in, and what happens is they pump the markets in the pre-market session. And then when the bell opens, this is where everybody else, all the retail traders, jump in and start trading these markets that have been pumped in the pre-market session. So they use the pre-market session to do the pump. And then they get all the retail traders jump in and start trading those pumped markets. And then after they run it up a little bit, then it dumps. That's why they call them pump and dumps, because it's based on news. Usually news will come out and they'll pump these markets up and make them run. So there was this, you can see right here on the we got the Russell down in the right corner, but you can see right here, this was a 5 o'clock. So that was the opening pre-market bell opening session. It came along. And then right here, this was 6:30. This is when they released the news, the retail sales news. And so that's why the market ran crazy there. Again, still pre-market session. And then right here, this is where the opening bell came in. And this is where you can now use market orders and limit orders. Again, if you'd have turned off the pre-market session, you wouldn't have seen, you don't see any of this activity. So most charts, like if you go to, cheap little free internet charts, they're not going to give you this information here. They're not going to show the pre-market session. All they show is the opening bell, and they just show a gap from yesterday's close to today's open. And that's how that works. So if you get a little bit more sophisticated trading platform, then you get to see the pre-market session. And if you get a live trading platform, you can actually trade those pre-market sessions. Just remember, you can only use limit orders to get in and out. So just limit orders, the only thing available in the pre and post-market sessions. All right, now I want to show you something else. Let's jump back over to the futures market and look at this market go. It's giving us our opening range. So I want to show you something else. If we bring this full screen in Track and Trade, if you right click on the chart and say chart overlay and come down here, you can see this where it says time zones. So turn that on, and you'll notice it turns on some colors down here at the bottom of the screen. And that tells you when other markets around the world are opening up their exchanges. That's how you can trade all night long, right? You can trade all night long because you're trading on different exchanges that are open and trading these markets. Our exchange may be closed, but the New York exchange opens at 6. The London exchange, if we come over here, slide all the way back. This is let's shrink this down a little bit. The London exchange opens at 1 a.m. my time, Mountain Time, right? So we slide over here, and then the Tokyo exchange closes at 1 a.m. when the London exchange opens. We then have the Sydney exchange, and it closes at 11 o'clock, and it overlaps the Tokyo exchange, which, let's do it this way, which opens, the Tokyo exchange opens at 4, and Tokyo opens at 4, the Sydney Exchange opens at 2, and the New York Exchange closes at 4. All right, so that's how that all works. And of course, that's including the pre and post market sessions of these markets. So you have different exchanges around the world that are trading, and so that's why you get 24-hour markets. All right, and that's generally, that comes from the forex market or the foreign currency market, and that's how those foreign currencies are traded 24 hours a day too, because they just trading across different exchanges. All right. So now you understand how you can trade a 24-hour market around the world. Okay, so that said, let's turn that back off. We don't need that on. And we're going to come down here and turn off time zones. And we're going to go back to our single view, multi-view. And let's see if there's not an opportunity for us to maybe put an order on. Okay, first thing we're seeing is up here on the S&P 500. This market broke out and started to rally. The question is it going to continue? Now, it's hit the blue. We used the area of support here, resistance at first with that blue line, came back down, touched it, gave us support. And now look right here. We got this little red bar, which can be a buy signal, right? If we think this market's going to continue higher and continue that uptrend, that would be a good place to get in. Now, I'm not real confident about that because we're still just in the morning bail. So I think we're going to, go up and then flush down. We may continue higher. It's up to you if you want to, risk it and take that position and see if it wants to rally. It looks like it's going to. You could jump in right there. That's a great place to take the continuation. It's breaking above the previous high. See if that market wants to go up and test this previous high right up in here. All right, we got a couple of important price levels up in there. We got a couple of important price levels down in here. So we'll kind of mark those off. And we'll mark these off here. You'll notice the Dow is broke above those. Again, we got the little red bar right there that's giving you the little hesitation in the trend. So you got the trend that started to rally. There's your hesitation for your second rally and see if it wants to continue. Now the NASDAQ came in here, and I'm going to trade, if you saw the little marquee, the little thumbnail, we're going to try trading the pyramid strategy. All right. And I'm going to teach you a little bit of the way I kind of like to do it. There's lots of ways to skin the cat. I'm just going to show you one that's worked for me the best. Okay, here we are coming in here with the same thing on this on the Russell. We're getting a little hesitation. You want to take that strategy right there, that little break higher, that would be a good spot to get in. So we're going to come in here and we're going to draw this in. It's interesting that the market's rallying on bad news. Okay, so we got a couple of spots in here. We're going to draw our trends. Now the NASDAQ is not rallying. Of course, it's falling. It's cascading down. There's our break right there on the Russell. That'd be a good spot to get in. Again, taking that market. The thing is it going to push through? This is the question I'm having right here. I'm not sure if it's going to push through like we like it to do, right? And here the NASDAQ's falling. It's giving us the same thing to the downside. So here's that little pullback, you guys seeing all this? Let me bring this full screen, make it a little bigger for you. So there we're getting that little break. Now this is a continuation of the downtrend. So we would expect or anticipate this market's going to continue to fall. Okay, so the Russell is following through. The Dow is trying to follow through. It's kind of showing a little weakness in there. Watch the volume. The volume is kind of key here. When you have a breakout like that, you want increasing green bars, and we got those. We got that, a couple increasing green bars. But on the S&P, where we were looking at that thing to break higher, it failed. Look, the volume, it came down, lower volume. So that's not good. That's kind of a key that little rally is going to fail up in there, which we know. We've been doing this a lot, right? So we know that these markets have a tendency to go up and then turn and fall and flush, and then they kind of settle out and decide where they want to go after that. So we kind of like to let them settle down a little bit. Doesn't mean they can't just take off and go and trend. They do that sometimes, but more often than not, they'll make these rallies and then they'll turn and flush, and then they'll come back, and then they'll start making and that's a point of where they start making their better trends. But I want to introduce you to the stochastics indicator. We haven't talked about the stochastics indicator much. I've mentioned it a few times in a few classes, but never gone into it in much detail. So let's use the Dow. We can use that. Let's use the Russell. Let's use the Russell. I'm going to bring the Russell full screen. Since the Russell 10 is seeming to be the one that's working for us, which seems like that's the one that always seems to work a little bit best for us, doesn't it? So we're going to come in here. We're going to look at the Russell. And I'm going to pull the indicators up, and I'm going to turn on the stochastics indicator. All right. And we're going to turn on stochastics. SSTO is the one I want, slow stochastics. And I'm going to turn off the MACD because we've talked about the MACD. All right. We know the MACD. So I'm going to turn that one off. And we're going to just talk about the stochastics. The other one I want to talk about, I'm going to add another indicator in here. I'm going to talk about RSI. Now, RSI and stochastics are almost exactly the same thing. Okay, they're almost exactly the same thing. It's just, for me, it's a little easier to read the stochastics. So you'll see me use the stochastics more than the RSIs. Not that I don't like the RSI, I certainly do. It's written by the same guy that wrote the ATR. And, I love the ATR. This is written by a guy named Wells Wilder. And I never met Wells Wilder. He wasn't at the exchange when I was working at back there. And never did meet him. Would love to have met him. I love his tools. Everything Wells Wilder did, it's fantastic. In fact, there's very few books that I keep on my desk. I keep 3 books. Well, one of them's my own. Then I keep my options book, right? We've talked about that one. I've got my stock market almanac. Of course, that's last year's. That's the 2023 version. You can't see it. I don't know. My little camera keeps clearing things out. And then the other one is Wells Wilder's book. So I got Wells Wilder's book. Oh, you can't see it. I don't know how to make that camera show it. I don't know. Anyway, it's Wells Wilder's book. It's called The Adams Theory of Markets, or What Matters is Profit. So those are the 3 books I keep on my trading desk. Of course, I got a library both here and as big as my arm, as here and in my offices up north. I've got huge libraries of trading books, but those are the ones I keep on my desk. So that, pretty important stuff. So anyway, he's the guy that created the RSI. And you'll know RSI is quoted a lot. A lot of people use RSI. Here's another little spot right here. You can take another long position on this break higher right here. This market's trying to go higher one more time. So we would come in here if we labeled this according to our labels, right? This would be our A1 right here. This would be our, we're going to call it A2. And this would be A3. Now, this is the 1-minute chart. Doesn't mean it can't do A4, A5, A6, A7, A7. It certainly can, as long as it stays above and does not break these yellow dots. As soon as it breaks the yellow dots, we either fail or we go into the B drive, right? So this is our A3. Now, is the A3 going to fail on us, or is it going to pull through? If it breaks the yellow dots to the downside, that's a failure of the A3. If the A3 is going to succeed, it's got to go up and break new highs and continue higher. It's got to break. All it's got to do to be considered a success, it's got to close above the high. All right. We don't know how high it's going to go. Now, it didn't go much high. It didn't go very high on this one. That was weak. That was a real weak rally up in there. Should have gone much higher. Should have gone equal to, we want to see it, what? The Fibonacci bow tie, right? We want to see equal distance. In fact, on the B drive, we want to see it to be outperform the A drive. That B drive should have been bigger. Now, we can go to a longer term chart or a shorter term chart and get different views, right? This is a 1-minute chart. What does the 2-minute chart look like? We go to the 2-minute chart. We got this little flag right here. Never did go red. So that's why we look at multiple time frames, right? We want to see what the market's doing. This is all just one big long green trend. But if you look at them together, you can see a little bit more detail. Of course, if we open up the range bar 6, we're going to see even more detail. All right, let's turn on Heiken Ashi on that. And now you can see that this whole drive up in here is all one big long drive. So that's that pullback that we were calling a little flag formation, right? So this is the little flag formation that we're seeing in there. Like that. All right, so that's the flag that we saw in here. 2-minute doesn't even show it red. All right, so you can label them like this, A1, A2, A3 from each one. You just kind of have to learn how much information you've got. That's why we look at them together. I'd put them all on the screen at once, but then we still have the Dow, the NASDAQ, and the S&P in here as well. So we've got 3 charts on the Russell. So anyway, that's the point that I was trying to make there. Let's come back to our lesson. So I get distracted sometimes and forget what I'm talking about. Market comes in and starts doing something that I want to point out to you, and then I forget where we were talking. So let's come in, and I want to talk to you about the stochastics and RSI indicators. Now, what's unique about these RSI and stochastics indicator? I'm going to take off. Look, we're getting distracted again. We're losing volume. Volume is starting to drop off here quite significantly. So we're going to get up into these upper regions of these markets, and so this could actually be a good thing for the strategy that I want to talk to you about. So the point that I'm trying to make is I'm going to remove the volume, and I'm going to turn the MACD back on, and I'm going to remove the volume. So now we're going to compare these three indicators. Now, again, the stochastics and the RSI are basically the same thing. The difference is the stochastics has two lines, and when they cross is an important point. If you go into the software and you go into the settings, you can play with the settings. You can turn on the arrows, and you're going to see that you're going to get arrows crossing. Now, you'll notice that these arrows on the stochastics, they cross at these little points right here. Okay, so that's what they're telling you. It's telling you, hey, this market is flagging like that. All right, so you're going in an uptrend, and then the downtrend is telling you, be careful, this is the top. This is kind of the top of this little trend. Now, usually, depending on what drive you're in, A drive, A2, A3, is whether it's just going to tell you the top of the flag, or whether you're going to anticipate a continuation of the uptrend, or whether it's a reversal, because it could be very well just be a reversal too, right? But that's what it does. And everybody looks at these and says, oh, that stochastics indicator, that's a piece of crap. Keeps telling me to sell, 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 sell all the way up an uptrend. Well, don't look at it like that. These are not buy-sell signals, remember? These are indications that tell you the market has changed from bullish to bearish. And if we're looking at a Elliott wave pattern or a three-drive pattern, when these things all come together, you got to understand what they were designed for. Okay, so what they were designed for, the stochastics and the RSI, was designed to tell you when the market peaks out based on a specific scale. And if you're looking at the third drive, so this is the third drive, it went up, and now this becomes the X3 right here, right? So this is your highest probability for a failure or for a reversal point. This would be X3. And so we would expect the market to fall right here. We don't expect it to go up and create an A4. Doesn't mean it can't, certainly can. You got your stochastics indicator giving you an arrow right there. And that's telling you the market's pulling back. That means that A3 drive has completed. It's done. All right. So doesn't mean we can't come back at this pullback. We certainly can. We can come in here with an A4. It's just pretty rare. Probabilities are not high that this is going to go up and create an A4. We're just going to watch and see. Now it broke. Okay, it didn't. It broke. It didn't go up and create an A4. So now look, it broke. So we got a yellow arrow right there. See that yellow arrow? That yellow arrow means that it closed below the average true range. So now if this does continue to rally, which it very well could, it could come in here and break this. But because it closed below the average true range, this is no longer an A4. It's now a B1, right? B1. And B1s, we like B1s. B1s are pretty good. Those are good setups. If that wants to break through and start to rally again, B1s are pretty good. We generally expect B drives to be bigger than the A drives. Now you're going to want to go over and look at the 2-minute chart. You're going to want to look at the range bar chart. You're going to want to look at the 5-minute chart. You're going to want to compare those four and see how they all work out. But here on the 1-minute chart, we got our A drive, we got our B drive, or our A drive, A1, A2, A3. Pulling back, broke below, got the little confirmation that our first drive is done. That's drive 1. And that's our AX3. Okay. So in here, you can have inside the A drive, each one of these little breaks have this little red pullback, gives you the flag formation, and the stochastics indicator is going to point that out to you. So let's come in here and look at the RSI, and the RSI is going to do something similar. So the RSI in this case did not point out this first one, because the market didn't actually cross below the 70% threshold. It did cross below the 70% threshold up here on the A3, and again, it did up here on the eighth, well, the peak of the A3. So the A2, I mean. All right, so that's your reversal point up here with the RSI. So that's what the RSI is showing you. It's showing you these little peaks in the little valleys. The little trend is over, so that's what they're showing you. Now, what about the MACD? Let's go look at the MACD, and I'm going to show you the difference and why these have different. Let's turn on the MACD arrows. So the MACD arrow, now it's only got one arrow right here. See the blue one right there? That's the MACD. It tells you the entire drive. So it tells you this drive is over, and it's not as sensitive, and so it doesn't tell you all the little tiny drives in here. it doesn't point those out. All right. So when we say we're on the back side of the MACD, what we're saying is we've completed this first drive and we're coming down the back side. Now it could turn and go back up and create the B drive, right? So this is a failure. This X, we call it X3, but it's actually X1 because it's the first drive. But we had three locations. So it would be X1, X2, X3, right? For the fractal side of this market. But we're going to come in here and let me delete all these arrows. And we're going to call that X1. And the reason I call it X1 is because it's the first drive on the MACD, right? So X1. So we're going to actually go into the B drive, and that would be drive 2 on the next rally up. And then when it fails, that would be X2. And then we'd go up and we get a C drive, and it'd be X3. And that would be the overall daytime failure of the 3 drive failures. And then we'd look for the retracement back. Right now, we're just kind of watching this market come back, see how far it comes back. We could do the Fibonacci ruler thing and measure that. And if it comes back, we're going to anticipate it's going to probably come right back into the Fibonacci sweet spot, right back down in here, which would be a point in which we would look for and anticipate that would be the market where it'd turn and rally once again, once it gets down into this region. The other thing we got looming down here is that blue line, right? So it could come down and it could touch the blue line. So down in here, we get a convergence of all of this stuff coming together. And this is where you're going to get probably a turnaround point right down in here. Now, it doesn't mean it can't completely fail and come down here. We see that all the time too, don't we? Especially when we have news events. News events, the market can flush up like that, turn around, and come all the way back down and just keep right on going. Now, usually we don't get a straight down. We'll usually get a little A, B, C, and then a continuation of the down. So right in here somewhere is probably where we'll get a decision point. That's what I call them, decision points, where the market's got to decide whether it's going to turn and go back up again, or whether it's going to make a little small up and then turn and fall again. All right, so it's a decision point. Now, usually a decision point comes when the stochastics indicator and the RSI indicator are in the center between at their neutral zones down in here. This is the neutral zone. All right, so up in here, the upper region up here is called the overbought region. The lower zone underneath is called the oversold region. And so the same thing on the stochastics indicator, overbought and oversold. These are overbought, oversold indicators, whereas this is not an overbought, oversold indicator. The MACD or the MACD is not an overbought, oversold indicator. Why not? Let me show you something. Okay, I'm going to clear all this stuff off, take everything off, and I'm going to show you. I want you to watch very closely. Notice that the RSI and the stochastics indicator say 100% right there. Can you see it? Right down in that corner, it says 100%. Right up in that corner says 100%. But yet, when you look at the moving average, the MACD, it says 350. It doesn't say 100. So from the bottom of the stochastics is 0. The top of the stochastics is 100. The bottom of the RSI is 0. The top of the RSI is 100. That means it's set on a 0 to 100 scale. That means it can't move. It's fixed. It's at a fixed rate. The market itself is on a dynamic scale. The market itself is not on a fixed scale, even though the RSI and the stochastics indicators are on a fixed scale. What that means is that the market can continue to go higher, right? As we all know, the market can continue to go higher, but the RSI cannot. The stochastics cannot. Once it gets up to a certain level, it can't go any higher. So if you look right here, see this first drive right here? This first drive is this drive here on the stochastics. Well, what happened? The stochastics got up into the overbought region and it couldn't go any higher. Look, it's stuck up there. But yet the market continued to go higher. See that? And so what did the stochastics do? Well, it got up to its highest range it can go, which is up into the 100 level. It can't go any higher, so it just kind of bounces around up there at that high level. And so that's why the stochastics has 2 lines, because if it'll cross up inside of that above the 80 threshold at this point, and you can change those thresholds, those are user definable, but most everybody uses 20 and 80. All right. And you kind of want to be a Me Too market. So you want to see what everybody else is seeing. And so your indicators and your tools should be set the way everybody else has them. Everybody likes to come in and say, oh, I like to change mine, make them different. No, you don't want things to be different. You want things to be exactly the same as everybody else. And the reason you want them to be the same as everybody else is because then you see what everybody else is seeing, and you want to see what everybody else is seeing so that you can be able to be a Me Too market, because the trend is your friend until it bends or ends. And if your trend ends the same time as everyone else, you're going to get the same signal to get out as everyone else and same signal to get in as everyone else. And I know that people are saying, oh, you don't want to do what everyone else is doing, but that's not true. You really do. You want to do what everyone else is doing. You want to find a market that's rallying and you want to jump on board. You want to find the opportunity, a place for you to get in and be a Me Too market. I want to get in on this big run too. All right. And so these indicators help you with that. Now, the difference between the MACD and the stochastics is MACD is not set on a 0 to 100 scale. So it can't go up into what we call, this is what we call the stochastics push or the stochastics pop. You'll hear it, some people call it the pop or some people call it the push. So the stochastics pushes up into that 100 region, and because the market is continuing to rally and go higher, the stochastics can't go any higher. So the stochastics has two lines, so they cross up there, and that's what gives you the arrows. If that crosses above the 80 threshold, then that's what throws the arrow. That's why we got an arrow here on the stochastics, but we didn't get the arrow on the MACD, because the MACD throws the arrow once it crosses back into the neutral zone right there. So see, it goes up into the overbought region, and if it doesn't cross back down below the threshold, it doesn't throw an arrow. Okay, it doesn't print an arrow. So this one printed an arrow here because it crossed below, and then it went back up into the other region, and then it printed another arrow as it came back down right there. All right. Now, because these are set on different scales, you only want to, in my opinion, when you start doing your pyramid building or your pillar building, you want to be very mindful, of course, of the 3 drive patterns. So you want to, drive 1, counter trend, drive 2, counter trend, drive 3. It's at this point that you want to start looking to take a short position. Now, realizing that you're in the A drive, and then, of course, we can get a continuation of the next drive up, right? But so if you come in here, you're going to draw your little trend line down there. It's crossing that, and this is a decision point. Remember, it could rally a little and then just turn and fall, or it could come up and start coming down and start giving you little flags to the 3rd drive back up again. And so that's your decision point. But reading the stochastics indicator, notice where the stochastics indicator is now. It's way down in the lower region, right? So this is way down in the lower region, indicating that we should see this thing turn and rally and go back up until the stochastics is back up in the upper region again. Okay, so when the stochastics and the RSI get down into these lower and upper regions, we call this an extreme, right? So those are extreme lows and extreme highs. And those are where you're going to get your best buy-sell opportunities, when those markets, those indicators are in their extremes. All right. Now look at the moving average convergence divergence, the MACD. We're not at an extreme. We're down in the very dead center of that histogram. All right. We're at the 0 zone. So we like to use these tools, one in combination with the other, and we can gain and learn information from the different indicators if we understand the concept. Now notice that the MACD is not on a 0 to 100 scale, so it cannot go up and find a top. So I'm going to show you something. Watch this. I'm going to clear off all the drawings, and I'm going to slide these tools. Now, what I want you to do is I want you to watch we're going to leave the scaling of the chart exactly the same, right? Meaning I'm not going to do this to it. I'm going to leave the scaling of the chart exactly the same. And we're going to slide these indicators, and I want you to watch what happens to the MACD as I slide it. All right, I'm sliding the chart off. Watch what happens to the MACD. Look. What's happening to the MACD right here? Right here. See it in this area or region right here? As I slide the chart back and forth, what does it read? What does it do? It rescales, doesn't it? Okay. Watch over here. As I slide it off screen, it rescales. It rescales with what's on your chart. So don't ever think, oh, the MACD is not up at the top of the chart, therefore it's got more height to go. That's not the way it works. It scales to the height of whatever the chart is currently. So you'll notice oh, I got to move this. Do this all the time. Get me out of the way. Let me see. Okay, see right over here, the MACD, the scale says 1.7 right now. So the top of the scale is 1.7 because that's how high the MACD went. But if I come over here and scale it, look, now it's at 3.5. And the point that was 1.7 is no longer the high. This is now the high. The market's getting more wild and crazy. So the MACD grows and shrinks. But notice that the stochastics doesn't do that. Stochastics is set on a fixed scale. Now, there's a lot of indicators that are on different scales. So we come in here and look, the AD, for example, watch the AD. It grows and shrinks too. It's not on a fixed scale. All right. It's on a relative scale is what we call that. So that's a relative scale. And you can see it as if you slide the charts forward and back. Now, one of the problems that you have with little cheap internet charts is you can't scale them back and forth. And so they're just kind of stuck there. And so you don't see this dynamic scaling of your indicators. Okay. So just need to take that into consideration and learn which indicators you're using. So let's come in here and turn on the CMF, or turn on the CMF, turn off the MACD, and we're going to move it, and you'll watch it. See, it's a scalable, it scales too, all by itself. See that? It's not a 0 to 100 scale. All right, so you can go through your indicators and you can look at them and realize that we've got a border set up here on the chalk and money flow, for example, 80 and 20. And you'll see that those are set in there at 80 and 20. But those scales don't really mean a whole lot because the market can scale down and up. So really, we only have to take into consideration the fact that what's on the screen right now, how does it compare? But the stochastics and the RSI does not scale like that. All right. So this is called the overbought region, the oversold region. We use it to help us identify locations where the market is in an extreme high or an extreme low based on the mathematics of these indicators. There are a lot of people who use these indicators. Therefore, you want to use them too. That's why we use the RSI. That's why we use stochastics. That's why we use chalk. Well, not so many people use chalk and money flow. Chalk and money flow is something that we use when you're in tune with the accumulation distribution model, which most people don't know. That's kind of a more advanced theology of trading. And so a lot of people don't use that. They don't know it. They don't understand it. And if they do use it, a lot of times you'll go watch these kids on YouTube, turn it on and think they're using it. And then they tell you all the wrong things and they don't know what they're talking about. So you got to be careful. I mean, they're learning, so you can't be mad at them. But sometimes you get kids start their own YouTube channel. They're wet behind the ears and they act like they're authorities and they teach you the wrong things. There are some good stuff on YouTube. I don't want to knock YouTube. YouTube's a great place to find lots of information, lots of great stuff, and there's lots of great traders out there teaching lots of great things. But there are some kids that don't know what they're talking about, and they go off telling you stuff, and it's just like, man, I don't know where you got that from. You obviously didn't read the book from the guy that wrote that tool, because you are totally off base on that thing. But they do it anyway, and that's, you just have to take that into consideration when you do anything, right? Anything in life, you have to decide who you're going to listen to. All right, so we're down here in the decision point trying to decide what we're going to do. The market is in a neutral zone as far as stochastics and RSI are concerned, right? Which makes sense because we know that if we take our Fibonacci ruler, we draw that across there, we're in the neutral zone. We're right back down here, kind of not quite in the Fibonacci sweet spot, but it did come right back and touch the 50% level on that Fibonacci sweet spot right there. Look at that. It's like a train on rails. Came right back down, hit that 50% level, and now it's turning and starting to rally once again. This would be a good place to get into this market right here for the next leg up, right? So we're going to look for that next leg up, and this is going to be a continuation on break above that red line. We're going to look for this market to go up and start the B drive. So this is the A drive. This is the counter trend. This is the B drive that's getting ready to start here. So what we want to do is we want to watch these indicators, wait for this market to get up here. We're going to test this previous high. That's going to be an important spot for it to go to. We're going to test that previous high, see if we can get above this first high. That's our first goal. See if we can't break above that high. The market's starting to die out a little bit. Notice that the accumulation down here on the chalk and money flow came down into the accumulation zone. That's generally where you want to start your accumulation. Now, if you're going to do dollar cost averaging, which is what this is all about, right? Is that you can start dollar cost averaging in here. And let's say we think the market's going to continue higher, then we would start dollar cost averaging in if that market came back down and gave us another little pull back down and then started to rally again is what we would anticipate, right? Now, if we go along the lines of what Bruce was talking about yesterday, he waits for the market to get much further away from the blue line before he starts looking for it to come back to the blue line. And that's his little That's the magic that he does, and he likes to do that. But if you're looking for the market to leave the blue line, then you can start accumulating positions like the chalk and money flow says down here. Start accumulating down in this region here in anticipation that the market's going to actually leave the blue line. Okay, so what if the market goes up and then comes down and comes back up and does this for a little while before it goes up? And you want to kind of accumulate a zone down in here. You can do the pyramid. Now, I have to tell you, right now may not be the perfect time to be starting to trade the pyramid pattern, right? Because like we talked yesterday, if you weren't here yesterday, go watch yesterday's video, because we're looking for an opportunity to get in on the X3. That's where we want to start our accumulating or building our pyramid, right? If our pyramid was like this would be a good place to start building a pyramid to the upside, because we're going to anticipate the market's going to go like this. And so we want to put in some positions right here. And if the market doesn't go, then if it turns and makes a fourth drive down, which is really rare, right? We could add on some more positions down here. And this is what would build the base of our pyramid as this thing comes down into a region where we don't anticipate it going very far. But let's say it goes once more and goes again. You can now build your pyramid, and you could add on to your pyramid down in this region here. You start building a bigger pyramid when a market's in an extreme. All right. Drive 1, drive 2, drive 3, drive 1, drive 2, drive 3. We don't expect markets to go into fourth drives. We don't expect them to go into fifth drives, but they can, and they sometimes do. So we're going to say or anticipate the market's going to turn at the third drive. But if it doesn't, we'll dollar cost average in at the fourth drive. We'll dollar cost average in at the fifth drive, and we can build our pyramid upside down like that, or upside right. It's actually an upside right pyramid, and then anticipate the market's going to turn and go at that point, and then we can start liquidating off as the market goes in our favor, right, with a normal pyramid. The same thing's going to happen in the other direction. So if we're going to see a market going to rally up like this, and we're going to look for a market to get up into the extreme, we'd wait for it to get up into the third drive, right? And then this is where we would start building our pyramid to the downside. So we come in here, and our pyramid, I always do that, but that's okay. You can tell what I'm trying to do. So then we get our pyramid up here, and this is where we would start adding in for the reversal to try and see if the market's not going to come back down. And as Bruce likes to say, back down to the blue line, right? So he's going to use that. And then he likes to try and have his profits taken off by the time it gets back. If the blue line, for example, was right here, Bruce is going to try and have all of his profits out by 50%. So he doesn't expect the market to do a full 100% of what we would expect it to. He's going to say, I'm going to try and have my profits off at 50%. And I would assume that Bruce is going to say, well, I'm going to try and have most of my pyramid taken off at 50%, but I'm going to let one run, and we'll let that one run in case it wants to continue lower. Leave that runner, that scalp and trail, right? Let that trailer go in case it wants to go all the way down and make you a whole bunch of money. So that's what we're looking for. We're looking for markets that make these wave patterns and where we're going to build our pyramids. Now, at this point, we're coming in. This is drive 1 right here, right? This is the counter trend. This is drive 2, and we're anticipating this drive 2 coming up. So if we started building our pyramid, we would not necessarily be building our pyramid at the most extreme at the top of the third drive. We'd be down here starting to build our pyramid right in this region here, wouldn't we? So that might be because we think, well, it might be because we're in class and I want to start building a pyramid, and I want to show you how. That's why we're going to be doing it right here. It's not the best time. You might want to start your pyramid here, because sometimes we don't go to the third drive. It gets too weak and it doesn't go up there. But you always kind of want to start building your pyramids at these locations up here where the probabilities are far in your favor, and where the stochastics and the RSI are way up in the overbought region, way up here. You're much more likely to get your reversals if those stochastics are up in these regions. All right. Same on the bottom side. You're much more likely to get your reversals if those stochastics and RSI indicators are, in this case, see down here at the bottom. All right. So that's what we're looking for. We would really like to see the stochastics go way up there and kind of hang around up in there for a little while before it turns. So what we want to see in this case, okay, this is our first drive. So this is our second. This is our going into the third drive. So we don't want it to break the yellow dots. Otherwise, it wouldn't be the third drive. So now we're going to come in here. We're going to label these. This is going to be B1. And this one is B2. And this one would be B3, right? So this is the B drive, and it's not performing like we want. The B should already have broken above this previous high before we ever get into B3. We want that to be challenging during B2, at least. B1, we want to come up and challenge it, break, and then B2 should go scooting way up there. So this is B2 right here, and then that's B1. So our B1 is our new break of the yellow lights. We get our first rally, our little pullback. That's B2. B1 to be perfect. I mean, if we wanted a perfect, what our expectations are, we want to go up and challenge that previous high, right? We want to go up and challenge that previous high. Then when it pulls back right in here, or maybe it might go past it, but we're going to get a little pullback right in here too. That's where we want B2, and that B2 should be really go, go, go. We want that B2 to be a nice big move, all right? And then the B3, oh, look, this B3 is failing. Then the B3 should come in up here and go up to the next B3. This one, we're getting this wimpy little A1. We're getting a wimpy little B2, and the B3 is failing, okay? Now, it hasn't failed yet. Oh, it just did. It failed because we got the yellow arrow. So that's a failure on the B3. That B3 failed, okay, because it didn't go up and create new green bars for the upside. So now we're in, this is not good. So we kind of died here. What are we going to do? Market's dead. Not a good opportunity to trade. What we should really do is go cook some eggs. Come back at 9 o'clock and see if the market wants to move at 9 o'clock. But we can't do that because we're here when we're in a class and we got to learn. So we're going to come in here and we're going to, I'm going to anticipate this market. Come on, buddy. Get up there. Push up there. And I'm going to show you how I like to build pyramids. Now, there's a number of ways of building pyramids, and that's what we're all trying to lead up to, right, is building pyramids. I'm going to shrink this down just a little bit. And, of course, remember that we should be actually watching and monitoring our other time frames and looking at the other markets. So we're looking myopically at the 1-minute chart. So we have to keep that in mind right now. I'm not looking at all the other different time frames, which we should be doing, and even looking at the multi-markets. We should be looking at what the Dow's doing, what the Nasdaq's doing, what the S&P's doing, because they're going to kind of tip us off to whether we can anticipate some continuation of strength or not. We should also have volume in here. And I got volume turned off because we were looking at these other indicators. So let's turn volume on. And we can see the volume profile is just dumping on us. That's not good. Okay, so this is starting, unfortunately, because we got this little arrow in here. In hindsight, it'll be 2020, and we go look at a different market too. But I'm going to turn off these arrows just to kind of help us a little bit. Keep the chart clean. All right. All right, so now we're breaking right here. We're finally getting our little break that we're looking for, okay? And we're going to look for it to break above this previous high. We got this high up in here. So we're kind of getting this ugly little, I really don't like to see, if we're going to call this an ABC pattern on the B drive, so if we're going to continue calling this the B drive, the problem is that, hindsight will tell us. But the thing is, this could be the B1, B2. This could be B3 right here. I just didn't want it to break those yellow dots, because usually when it breaks the yellow dots, that shows weakness, and then that starts the next drive. So this would be a failure to the downside on the B drive, and we're starting the new C drive. So again, we need to go over and look at other time frames. Go look at the 2-minute chart, which is my favorite chart for charting these Elliott wave patterns. I like the 2-minute chart. Keep that in, stick that in the feather in your head, in your cap, and say, oh, Land likes to do his Elliott wave counts primarily on the 2-minute chart when we're day trading. But this could be a number of things. This could be a C1, and the reason I'm calling it C1, the only reason I'm calling it C1 is because it broke the yellow dots. All right, so we started a new drive. So this is drive 1, counter trend between the yellow dots. Drive 2, counter trend. Drive 3, but it's starting to show promise. So this could also be, this could be our B1. This could be our B2. And this, instead of being a C1, it could actually still be our B3. It depends on how the market plays out, right? And you don't know. Hindsight's easy. We always go back and look at these things in hindsight. But on the fly, you're going to have to kind of realize that this could be one or the other. We don't know how this is going to turn out. But we go look on the other charts. We go look on the other charts, and that would be helpful. helpful for us to identify those other charts. Now look at stochastics starting to come way up in here. RSI is starting to top out up in here. We're getting some volume that's increasing. Now, the way I like to build pyramids is the pyramid would be for the downside, right? We're going to anticipate that the market is going to fall and come back down. Now, in reality, we're not going to anticipate the market's going to fall because we're only in we're in the bullish market. The trend is your friend until it bends or ends, right? And the trend is bullish right now. Overall, if we just, the trend is up, right? So let's start building a pyramid, and I'm going to show you how I'm going to anticipate a fall in price. So the first thing we're going to do is you can come in and you can say, okay, I'm going to take a sell right here. It's not a good place to take a sell, but we're going to do it anyway because we're running out of time and I got to do this. Okay, so we're going to come in here. We're going to sell right now. Now we're going to anticipate that the market's going to fall, all right? And it may very well do. We're getting up in here. You see the stochastics is trying to push up into the upper region. RSI is in the upper region, so I'm going to take a short position. But what if it doesn't? Well, I can come in here and start lining out like we did yesterday, different sell orders, right? But that's not how I like to do it. I don't like to come in here and just start dropping sell orders in here. And that would dollar cost average you up. What I like to do is I'm going to kill all those. This is the Christmas tree strategy. And remember, we talked about this yesterday. I think I got that in the slide. If I can, I find it real fast, pull it up for you. Yep, there it is. So there's the Christmas tree, right? And this is the Balaam's ladder. So the one we're doing now is Balaam's ladder. Just by doing Balaam's ladder, you're kind of setting it out there. Now there's a number of ways you can do it. You can do 1, 1, 1, 1, 1. You can do 1, 2, 3, 4, 5. You can do 1, 2, 4, 8, 16, right? There's lots of different ways that you can do Balaam's ladder. And there's lots of different ways to do the Christmas tree. It's the same thing. You can do 1, 2, 3, 4, 5. You can do 1, 1, 2, 2, 3, 3, 4, 4. There's no right way. It's just how it's going to work for you. How it's depending on what the pattern is. Okay, this is working out good. All right, we're getting a little bit of a rally in here. So rather than just put out a bunch of limit orders kind of randomly, I like to now come in here and I say, okay, I'm going to dollar cost average. So I start trailing up one price bar back, or I can trail on the ATR, and then I'm going to dollar cost average by adding another position in. I'm not going to stop out. If the market continues to go, I'm going to let my order continue to trail until it intercepts. This is called an intercept order, right? We've talked about that. So this is an intercept order, and the market is going to turn around eventually, right? My goal is wait for it to get into an extreme based on the stochastics and the RSI. Wait for it to get into a good count up into the C3, right? That's a good spot. Or if you think it's going to turn at the top of the B3, you can do that. Or even here, this would have been a somewhat decent place up here at the top of the A3, looking for that X3, right? Or the first break of the X1 to be that fallback. I don't know what the heck you're talking about, Lam. X1, A1, A1, B1, C1. Well, it's all laid out in my manual. This is the Stock Market Playbook of Strategies. You can go get this. It's on Amazon. Just search Lan H. Turner and it'll come up. And in here in this book, you drop this down, we can get in here, and this is where it's all laid out for you. All right, there it is. So there they are. Okay. Oh, we got filled. So our intercept order just took us short on the next position. That's how I dollar cost average into a position. If that market would have continued to rally higher, I would have just kept trailing up until I get the reversal. So I don't put the order in until the market wants to turn on me. That's how I dollar cost average. Now you can put them out there like Balaam's ladder if you want to, but I like to trail for an intercept. Now, if the market doesn't, right? Okay, what if the market doesn't fall right here? I just got my short two positions. Well, I could come in and start saying, okay, Balaam's ladder, right? Lay it out there, give myself my different shorts and dollar cost average in as the market goes against me. But that's not how I like to do it. Again, I like to use intercept orders. So that market starts to rally once again, and I want to put another one on. I just drop another one in here, and I start trailing up one price bar back and wait for it to turn once again, and then that's where I add my position. Now, I've got two in, and if it goes way up here, let's say the market turns and goes way up here, I can start trailing with two contracts, which would pull my dollar cost average up because I'm in with two. It would pull it up 50%, right? So it would go from where I'm currently trading up to where I have my my intercept order would cross, and that would bring my dollar cost average up, boom, 50%. If I went in with 2. If I only go in with 1, it would only bring my dollar cost average up by 33%, right? It'd only bring it to here. So the more you dollar it's away from you, the more it's going to bring your average price up. Right. So in this way of trading, you don't really use a stop order. And so you just kind of wait for the market to go up there until it eventually turns around and comes back down and flushes to the other side and makes you money. But you need to be able to count these probabilities. Where's the market at probability wise? A drive, B drive, C drive. Let's get into some real high probabilities. Let's make sure the stochastics and RSI way up in the other high upper regions up in here. So we're coming into a C2. Now C2 should be the biggest drive of the C drive, right? So this is a C2. So in here, we're going to call that a C2. All right. But Lan, I thought this was the top of the B drive. Well, hindsight will tell us, but we're getting up here and we're anticipating a continuation of the uptrend, right? Because we're in the third drive. So this could still be actually just be the B drive. So rather than being a C2, this could be B3, and that would be a B4, right? But because we got this little flip-flop right here, we got to start counting this a failed B3 and a C1, C2. And it doesn't mean the market can't go into a D1, D2, D3. If it's got strength, they just keep right on going, but we just don't generally expect that. So again, go look at your 2-minute chart, and you're going to see a little bit better view of what these drives are, and it's going to be easier to count on the 2-minute chart. But we're going to sit here and I'm going to show you how I dollar cost average in. So again, rather than just kind of randomly coming in here and saying, well, I think I'll stick one up here. And we don't generally, even when we do it this way, we don't kind of randomly do it. We like to come in and we like to come in. I'll go show you. I like to have chart preferences. And I like to bring this in and put them at even numbers. So we put it at 10. So this would be another good place to put some orders. Or you can go 5, right? That's an even number, half even number. And so then you could put your order right there. So you put your orders in here to these even numbers, because the market likes to go between evens and halves. So that's how you build your pyramid if you're going to do it that way. But again, I'm not a real fan of doing it that way. I like to just wait for the market to actually turn around for me. And so I'll just trail up. And then when it turns around, that's where I dollar cost average in. Now, depending on how high that goes, would be determining whether you want to dollar cost average in with 1 or whether you feel like you need to do 2 to bring your average price up higher. Now, to do this, I would recommend, if you're a beginner, you do this strategy in a micro account, not in a mini. Build your account up so you have some nice reserves in there before you move up and start doing the strategy on a mini account, because a mini could rip your wheels off really fast, because it can get nasty, right? If you start dollar cost averaging and you get in too early and start dollar cost averaging in a nice, big, beautiful uptrend, you can, get yourself in trouble. So I'm not going to dollar cost average till the market actually turns around. Okay, we're getting lower highs up in here, so this is starting to show weakness. So maybe we'll get another dollar cost average here. Now, again, I can change that and have that be quantity 2, and I dollar cost average in with 2 because I'm in with 2, so that would bring my average up by 50%. If I only do 1 and I have 2, it's only going to bring it up by 33%. Okay, here we go. We're going to fill in one more. Okay, now we have 4 contracts short, but look at how close I am to the market, right? That dollar cost averaged me in. So now all the market has to do is come down. Now, if you start getting nervous, you're like, oh man, I got pretty heavy in here. This is I don't generally like to trade with 4 contracts. I like to start with 3, or I like to start with 2. Well, come and put one at break even and take one off as soon as it comes down there. And that's okay. You're like, well, I want to be rich. I'm going to let all 4 go. Well, take some of that exposure off if it makes you nervous, because this market could easily turn and go back up, and now you'd be up with, you're up with 4 contracts going in the wrong direction. This way, now we're only up with 3 contracts going in the wrong direction. So we took some of that exposure off, and, oftentimes you might want to start with just, how much exposure do you want to have? Oh, we might want to take another one off, just in case that thing goes. Now I'm only exposed to 2 to the downside. What's the advantage of doing that? Well, the advantage of doing that is if the market turns and goes up, you're only exposed with 2, and you can start building your pyramid again. What's the disadvantage of doing that? Well, I had 4 contracts, and if that market falls and goes all the way back down to the blue line, I could have made a whole lot more money. So there's an advantage and a disadvantage to everything that you're doing. I always like to err on the side of caution. So I will, as soon as that market comes down and gives me a little bit of a reprieve, if I feel like I got a little bit too much exposure, I'll take it off right at break even. So I would recommend, bear my testimony that you should always err on the side of caution. So now we got 2. Now we can start doing this is what I call the king tut. All right. I call it the king tut because we're going to trade pillars and pyramids. So this is my king tut strategy because we're trading pillars and pyramids. Now what we can do is if this market will actually turn and fall and start to give us a nice downtrend, we can come in here and we can start trailing behind, usually I try to do the ATR. I like to trail behind the ATR. So we'll see if the market can move with a big enough move to the downside to trail me down on the ATR. So if that's the case, I'm going to come in here and I'm short 2. I can break it apart. I can be fancy and come in here and say quantity 1, stop, and I'm going to drop this in here and put it way above because I'm going to make it jump to where I want it to go. I'm going to edit and I'm going to put this in and say I'm going to trail price bars back 1.1 and it's going to trail 1 price bar back, and I'm going to put my other one up here and I'm going to right click and tell that one I'm going to trail on the ATR. All right. Now, as the market starts to move down, if these markets will get into a situation to where they're profitable and the market continues to trail, I can then start doing what I call the king tut, or building my pillar. So this was pyramid building, right? So when the market's going against you and you're adding positions, it's pyramiding. When it's going in your favor and you're going to take profits along the way, that's pillaring. So it's pillaring and pyramiding. All right. We're running the king tut. So you'll hear me say, what's the king tut, Lan? Well, it's a strategy that involves pyramids and pillars. And we just need to get the market to cooperate and give us a good enough move to be able to build our pillars and pyramids. And if it doesn't, then all we can do is scalp and trail. We scalp and trail on wimpy markets, and we pyramid and pillar on strong markets. So now we're trying to build our pillar. And our goal is to have this thing come back down to that blue line, right? And in the case of if it goes down, these stop orders that I have in here are going to trail. And as they trail down, they're going to start moving into areas of support or into a profitable territory. Once they get into a profitable territory, the market should give us a little reprieve, right? Kind of pull back. I don't want it to break the yellow dots. It could take one off, but then we want it to fall once again. And when that happens, I'm going to dollar cost average into a lower position. But I don't want to dollar cost average in and have my average entry price fall below my trailing stops. Okay, now I'm getting a little aggressive, so I can back this one off. All right, or I can say, well, I think the market's going to wimp out on us. Where's it at in the 50% ruler? And say, I'm going to take a profit off if it comes back and breaks higher, because this is drive 1. This is drive 2. We're coming back into the Fibonacci sweet spot, and we'll break and go higher. And we'd probably, we could anticipate going into drive 3 up in here on the longer term basis. So these little drives in here, these are called the fractal drives, where I say drive 1, drive 2, drive 3, drive 1, drive 2, drive 3. Those are fractal drives of the overall longer term drive 1, drive 2, drive 3, right? Markets don't have to always go through 3 drives, but you can see pretty prevalent, those 3 drives in there. You can see them. Okay, so let's come in here. Let's get rid of all the drawings and see what's going on here. So at this point, see our trailing stops have got into a profitable zone. So if we want to, we can do what we call castle. So I come in here and I sell the market because I'm in with 2. I sell, and look, it moves my order. Dollar cost averages it down. I generally don't like to do that if it's still behind, but I like it to be, not to jump my average till I'm into a losing position on the stop. But as soon as I do that, I take that right back off. All right. So that's called castling, where I took some profit. So I'm not building a pyramid on the way down. I put one in, so it only draws me 33% down, not 50. And then I take it right back off. So I took some profits. All right. And as long as these stops keep moving down and the market keeps falling in our favor, let's see if we got 9 seconds and our stops should move for us. 2, 1. There they move. Okay, now I'm going to take some profits. I'm going to sell, and now I'm going to buy. All right. So now I took some profits. Took another $100 out of it. And my trailing stop is still, I'm going to move this trailing stop. It's on the ATR, and we're just being a little bit aggressive because I'm trying to, right? Example, we might be a little bit more cautious. Might even go out to a 2-minute chart at this point and let it only trail on a 2-minute chart and look for a longer term trend. And then we could even go out to a 5-minute chart and let this thing really go. And really, we got some good money. We got $300. We could be a little bit more aggressive, go out to a 2-minute chart, go out to a 5-minute chart, and start trading on a longer term time frame and see if we can't catch a longer trend and not try to be so myopic all the time. Okay, we want to see it move again. So we got 6 seconds. 6, 5, 4, 3, 2, 1. Move. Let's take some profits. Now at this point, I don't really need to. It looks like the market. Well, let's push down there. There we go. We'll take some profits right there. Sell, buy. All right. So I just took another profit. So as that market pushes lower and breaks those lows, I wanted to take some profit right there. And as long as my stop is still below my average price, which I keep bringing down every time I take profits, it moves that down, but I don't bring it down further than what my trailing stop's at. Now we got a pretty aggressive trailing stop because we're just trailing one price bar back. We're not back here on the ATR. So we may get stopped out prematurely, but that's okay. We're up $400 and we got 178 in open profit. We're 2 positions, and we're going to see if we get stopped out right here at break even or if it wants to go again. And this is the great Lanturner King Tut strategy. Okay, what's going to happen? What's going to happen? There we go. We got stopped out. We got $465. And I hope that was a good lesson for you to learn stochastics, RSI, MACD, chalk and money flow, pyramid, pillar, and the Lanturner King Tut strategy. Let's go look at let's see what people are saying this morning. All right. So Bruce is saying good morning. Good morning, Bruce. Hope you're still here. Hope you saw that example. Gary Thomas says good morning. Kirk says good morning. Michael Bruce says good morning. Paul Gifford says good morning. Laura Lowdown Killer says good morning. John David Lundberg, top of the day. WC Randy says good morning. Brian Johnson says good morning. Lowdown Killer says Pit News Magazine had a few stock tips from at the end of the February issue. I threw a bunch of money on the AON and it marked on, let's see, let's put this up here. Bunch of money on AON and it marketed on my calendar. It marked on my calendar to check sell it today. I just cashed out and earned a nice 7%. Cool. Very nice. Sweet. So that came in we're going to do that again in this Pit News Magazine. We're going to put 3 more trade recommendations in there. So Pit News Magazine is more than just, articles about trading. We try and make it put some other stuff in there that's helpful. Like, the most important thing that's in there, I would say, is the poem. I love the poems. I work on those a lot. I know that they're done by ChatGPT, but still, I work a lot on them. I have ChatGPT help me create them, and we create we create a theme, and then we come up with a theme based on this one's going to be the March theme, and then we come up with a different style of and we look at different styles of poems, and then I have him run about 6 or 8 different poems, and then I take different pieces out of each poem and I construct the poem to make it sound the way I want from the 6 different poems that he wrote. And I mean, it's a lot of fun. I enjoy doing it. I'm not going to take credit for it other than just I prompt him a lot to make him do it. And then we come up with a pretty good but it's fun. I think that's it's my favorite part of the magazine is those poems. All right. Anyway, I digress. Lowdown Killer say we definitely need to get some more stock tips coming out of. All right, I'm going to try and do that on Mondays. I think that's a really good idea. I'll try and do those on Monday. So I thought that was a good recommendation. B. Taylor says, good morning. Michael Bruce says, I find that whenever I trade with more than one contract, everything's to go wrong. What do you think I should do? Well, I think you should do what I just taught you right there. All right. But it takes a lot of practice. Okay. And you want to make sure you're doing it in areas of extremes. When you start building your pyramid, be very wise about where you start building that pyramid. You want to be at your extreme on the Elliott wave pattern. So you want to be at the top of a third drive, whether you're going to try and can't take the counter trend or whether you're going to try and take the trend. You want to be at the top of the third drive before you start building your pyramid. And if you're lucky, you don't have to build a pyramid. The market will just flush and you'll go down. You'll make money off your one contract or two contracts, however you enter. But I would do that in the, if you're going to pyramid build, I would do that in the micros. Don't try and pyramid build in minis until you're really quite proficient at doing it, and you have a pretty sizable account. All right, because it can get out of hand very fast. All right, Rock Steiner says good morning. Paul Gifford says good morning. So Paul says he's kicking butt today. He's up over $1,000 in his trading and his practice trading. So that's great. Keep it up, man. That's what you want to see. You want to see some of these great trades. So we're up $465 today in our little demo account. Accidentally made some money again today. Let's come in here and bring that up for you. So what do we say? $465. $465. And we're going to come in here. We've got to make our notes. New note. We exampled and ran the Land Turner King Tut. King Tut. Let's give him a capital letter. King Tut strategy. Today started our pyramid at the what was it? That was the top of the second drive. All right. And so we traded just the counter trend down. That's what we did. All right. So we pyramided up and we rode the, what did we ride down? We rode the pillar down. All right. There we go. Always make sure you journal your work. 465. Let's bring this all down. And we certainly met our goal today. Our goal today was $96, and we made that $465. So we beat our goal by almost 4 times. So pretty nice there. Well, actually, we beat it by over 4 times, almost 5 times. All right, guys. So let's look. We had 4 winners. How many winners? 1, 2, 3, 4, 5. So we had 5 winners. 5 winners. 1, 2, 3, 4, 5 losers. So we're at 50%. Win-loss ratio is 1. We're on average losing $169 a day based on our losses. But hey, we're picking that up a little bit better here as we train and do a little better. This is our nice big winner today. Change it green. And I have a Sunday school lesson for you. I know we've just been doing a lot of lesson, but I got a little quick Sunday school lesson for you. Here's your Sunday school lesson. Oh, we did this Sunday school lesson, didn't we? Let's go to the next one. This is your Sunday school lesson. Get the right tools for the job. Most real live trading platforms have a platform fee. Don't think you can beat this guy trading like this guy. Your profits come from that guy's pockets. All right. Free trading platforms are the most expensive of all. Think about it. Why do you think they're free? It's because they're getting money from you another way. Nothing in this world is free. If you're getting it for free, you're paying for it some other way. All right. So don't think you can trade on your little, this is just kind of a quick little Sunday school lesson to warn you. Don't think you can do the kind of trading we did today on your little iPhone and beat the guy that's doing it with a professional level trading platform and multiple monitors. All right. That's all that's about. Just get the right tool for the job. We've talked about this in the past. You don't want to be a mechanic with a pair of pliers. You're not going to go take your brand new $60,000 Ford pickup truck down to the Ford Motor Company to get it fixed and have the guy walk out with a pair of pliers and say he's going to fix your truck. You want him to have the right tool for the job to work on your job. You're the same way. This is a career path. All right. We're not just dinking around out here. This is real life. This is real money. And so get the right tools for the right job. And if you're not able to do that, wait till you can, go pump some gas at a gas station until you can afford to do it right. I want you to do it right, because if you're not going to dedicate and do it right, if you're just going to kind of dink around and sit around hang around the edges, that you'll be the guy that's giving everybody else, their paydays. So take it serious. That's all I'm trying to say. Take it serious. All right. And let's all do that little, YouTube stuff. That always helps. Like, subscribe, give me those little thumbs up, write some comments in the comment section. That's always good. And we will see you guys again tomorrow. Tomorrow's Friday. So we got class tonight. This is our last class of the advanced technical class at the university. So don't forget to come and join us tonight at the university in the Udvar Hazy building at 6:00. We will start right on time. So be on time. All right, guys, we'll see you tonight, or we'll see you tomorrow morning.